Howdy, Jacob here. Today we're looking at ExlService Holdings in the IT services industry. 7.5 billion market cap, essentially the same enterprise value. Current P just under 40. They operate as a data analytics and digital operations and solutions company globally, headquartered in New York, New York, founded in 1999. Their revenue growth has been extraordinarily impressive, where outside of COVID and 2014, their lowest year-over-year revenue growth was 9.1% and was as great as 25.9%. So they've over tripled their revenue over the last 10 years. You're looking at very impressive double-digit revenue growth. Their gross margin is increasing, operating margin increasing. Gross margin isn't as impressive as what I would have thought it was for a data analytics company, but their operating margin in the 10 to 15, 20%, possibly going into the 20% range in the next decade or two is very impressive. And the increase of return on invested capital is very impressive. So revenue going up, becoming more efficient with each dollar coming in. That's exactly what I would want to see for a business, especially a growing business is even more impressive since you reinvest a lot of the money to make more money at the beginning. It sounds like although they're a 25-year company, they still have a lot of growth, at least from what they've done historically. I think data analytics is just getting started. There's so many ways that machine learning can improve data analytics, and I mean it's only going to get smarter from here. So maybe maybe their valuation of 40p is makes sense or not. We'll have to see. So like I said, cost of goods sold is majority of their costs. Sales, general, admin is the rest. Not a lot of other expenses. We don't see R&D, which I found kind of interesting. Their balance sheet shows 137 mil cash, just under 300 million total cash-like products, with 65 million short-term debt, 135 million long-term debt. They have more cash-like products than debt on the long-term and short-term debt side. Feel good about that. And their CapEx has over doubled from 10 years ago, but their cash from operations has over tripled. And so I do feel good about this cash flow production, and majority of their cash flow over the last 10 years, you're looking at some share repurchases, some debt reduction, some acquisitions, some reinvestment. Hopefully these are at advantageous times. You want the company to be doing at that moment what's best for it, what's going to give them the best return. And so these acquisitions over here, this 232 million acquisition, 77 million acquisition, hopefully that was the most advantageous thing they could have done with their money. And based on their increase in margins and increase of revenue, they might have not been a bad idea. So I think that's enough to get me to make some assumptions here on the revenue growth side. Again, maybe I'm being too conservative. I think 10% seems pretty reasonable to me. For margins, it has been going up, so I will be putting in higher margins than would have been done in the past. I think that that's reasonable in my eyes, at least. 12 and 11% share change. Have they bought back shares recently? They have. Let's say they buy back with 50% of capital allocation. That's going to be about 100 million. With stock-based compensation, you're looking at 30 to 50 million. I mean, that's going to be about half of a percent. So I feel comfortable doing that. And then with the terminal PE, they're making acquisitions, they're reinvesting. 10% growth rate is very impressive. Maybe a 20p in free cash flow is reasonable. So based on my initial analysis, we're still saying it needs to fall in half. Again, a fantastic business, one that I want to own, but I'm not going to overpay from what I think are reasonable assumptions. And I don't just want to make frothy assumptions to make it look like a buy, even these amazing companies. If you understand this business, though, and you are extraordinarily confident it's going to last longer than 7 years, I know I do 7-year analyses since that's the average historical cycle of a business cycle. But if you know and feel very confident, you understand this business, you understand the industry and the sector, you think it's going to be around for 10, 15, 20 years easy and grow at double-digit rates. I mean, again, almost everything is going to grow into the valuation at that point, unless you have a 500 or 1,000 PE company at a 40 PE and it diverges down to 20 over a 20-year period, but you grow double digits, you're still going to get a massive return on that investment. And so for me, based on my initial analysis, based on my understanding, based on the financials that I've reviewed, it still needs to fall a little bit more. But again, a fantastic business. Hope you enjoyed the video. Have a great day.